Hello, my name is Chris Shea. I'm a financial advisor with BPS Financial Services. And in this presentation, we're going to talk about the basics for savings and investing 101. What do you need to know? What do you already know? What do you want to learn about investing your money? We're going to go over a few things in this presentation. First, what's investing versus savings? What's your risk tolerance? Going to use some terms and definitions so you understand when you hear things being said by people, it's not just verbiage to you. It actually means something. We're going to talk about working with advisors, brokers, and agents and kind of the difference between them. And then we'll talk about some cautions and scams so that you get protected because it's your money, you're investing it. Make sure that you actually get what you want out of it. So again, my name is Chris Shea. I'm a financial advisor with BPS Financial Services, and I help my clients with their retirement and investments in partnership to help them achieve what they want in their life. So start with, what's the difference between savings and investing? Savings provides funds for emergencies and making specific purchases in the near future. Investing is increasing your net worth in long-term financial goals. So what's an example of a specific near future purchase? You want to buy a car in a year. Don't throw your money in the investment in the stock markets. Put it in a savings account. You want to save $6,000 for a down payment on a car? Put that in a savings. Emergency fund. Have at least $10,000 in the bank, if not 3 to 6 months of your expenses. Why? In case something happens. You don't want to hit your retirement account assets, take the money out and have a penalty. You need to have both savings and investments because you got to have your long-term goals for retirement, taking care of yourself with your health, paying for things like weddings, colleges, whatever happens later in life. Investing, putting money in an asset that generates a return. You're going to buy an investment, stocks, bonds, real estate. Then there's speculation. This is not the same as an investment. The underlying asset doesn't have a discernible value. It's just kind of made up. Think gold coins, gems, baseball cards. Some baseball cards definitely appreciate, but it's a speculative market because they may appreciate, they may not. Art, much the same. Things can go up and down in value depending upon what the populace feels at that moment in time. Risk. What is your risk tolerance? And that just doesn't mean risk as it relates to stocks and bonds. There's a lot of different risks that needs to be talked about. Inflation risk. Happened a lot in the recent past. Rising prices erode your purchasing power. You feel poorer while you're still making the same amount of money. That's a risk. It's legitimate. Business risk. Does the business, are they going to stay in business? As we saw in the pandemic, some things floundered and fell off, other things flourished. What's going to happen? You don't want to put all your eggs in one basket. You want to diversify your business risk. Market rate risk. Markets go up and down. The stock market's up, it's down, it's up, it's down, it's down, it's up. There's market risk involved in investments. Liquidity risk. Do you have money available? Can you turn it into cash that you can spend right away? Or is it tied up for 6 months, 8 months, a year? You've got to make sure that you have enough cash on hand. You can't just put everything into, say, a home, because it might take 3 to 6 months to sell a house. You might wind up cash poor. Got to be able to have some cash on hand to handle liquidity challenges. Financial risk. This is when a firm takes on debt and they take on too much debt and they can't pay back their debt. They have to go out of business because they've got too much debt on their books to offset their revenues. They wind up cash broke. Interest rate risk. Higher the interest rate, less a bond is worth. This happens in the bond market, where if you buy a bond and the interest rate goes up on everything, your bond is worth less than it was before. So there's a bunch of different types of risk here. And we didn't even talk about your risk tolerance. So there's a lot of things to digest when it comes to risk. Speaking of risk tolerance, this is where we talk about diversification. Again, don't put all your eggs in one basket. Reduce your risk by diversifying your investments across multiple things. This can be multiple asset classes. This can be real estate and investments, cash, cars, lots of different things you can invest in, but make sure you're diversified so you're not all in one thing. Then asset allocation. Investment return is associated with the types of asset classes you choose. There are riskier asset classes that will go up and down, more volatile, but they'll also generally have a higher return. There are other ones that are more steady and have a lower return. You need to have a portfolio with a mix of both to achieve long-term success. Bonds. Here we get into definitions. I mentioned it earlier with the interest rates and the bonds being worth less. They produce a steady income. Why? You give money to an entity, government or a company. They're going to give you a coupon rate or return percentage paid annually based upon what you paid. 2%, 3%, 4%, 5%, 7%. They're going to pay you back that on an annual basis. They're relatively safe with low risk. Par value, that's how much you actually bought the bond for. So say you bought it for $1,000, you invested $1,000. The par value is $1,000. Say the interest rate is 5%. You're going to get 5% of $1,000 every single year, $50, right? Types of bonds. There's a lot of different bonds. You hear about them all. It's a very broad term, and there's a lot going on inside of it. Corporate bonds. We'll start there. This is where a company goes out and says, we want to borrow $100 million. They'll float some bonds for that, or they want to borrow $1 million or $500,000. Whatever the case may be, they'll write bonds, assign an interest to that, and collect the money, then pay out the interest on an ongoing basis, and then eventually pay out the par value when it matures. Municipal bonds are written by municipalities, local and state governments. Tax exempt share securities, not entirely risk-free. Some of them are more risky than others. Some of them are tied to revenue streams. Some of them are tied to taxes. Taxes tend to be safer, but they are tax exempt, so you don't pay income tax on it. So generally, they're going to pay a lower payout. Really great for managing your taxes if you want to invest in a taxable account. Junk bonds, low rated or high yield, meaning they're more likely that they're going to be called or go into default, and therefore they're going to pay out a higher interest rate. Some people like to speculate on these, but again, it's up to your risk tolerance. And then treasury and agency bonds, bonds that are virtually risk-free, a little bit higher rate than treasury for the agency bonds. We're going to talk about these a little bit more in a little bit. Investing in stocks, common stock. You got the blue chips, growth, income, speculative stocks, which are risky, cyclical stocks, which go in a prescribed cycle based upon where you're at with the economy, defensive stocks. If the economy goes to a recession, these tech companies tend to work better. All factors you got to play in there, right? With a stock, you're buying part of the company. You could get dividends or capital appreciation, depending upon the type of company it is. Limited liability associated with some of the stocks. Some of them have 100% liability. Not limited. Yes, limited liability, meaning you can't get sued for it. So you're not going to lose anything because of liability. You might lose all your value, but you're not going to lose anything more than you invested. And one little known thing is companies may repurchase their own stock. They can say, hey, it's a good investment to buy our stock because we think it's undervalued. It'll go up in value and we'll be better off for it. And so will our investors. Another thing you'll hear commonly are mutual funds. These are professionally managed funds, and you pay for that. There are minimal transaction costs because they're buying in bulk and they're spreading it across hundreds of investors. They may offer higher returns because they're diversifying their portfolio. And there's thousands of mutual funds to choose from. So you can go out there, find mutual funds. There's a large list. You can go and look them up. Individual stock and bond trading. This differs because instead of it being managed by a professional, you got to do all the research yourself. Requires a little expertise and a lot of knowledge. There are higher transaction costs because it's one person buying it as opposed to multiple people. And you're probably less likely to have diversification because you can't invest in as many things because you have a limited amount of capital, which is money to invest. Whereas a mutual fund takes a lot of money from different people and invests it for you. Again, there's trade-offs to both. Just got to understand the trade-offs. Types of brokers. Full service brokers, commission-based, give and execute trades, work as advisors as well, where you're going to pay a little bit more. I'm a financial advisor. I fall into this category as a full service for my services. I'm going to provide you, in addition to just the trading, a lot of advice and guidance and a view as to the implications of your choices in the long term. Deep discount brokers. They're going to execute trades 90% less than full service brokers. And at the same time, they're going to give you no guidance whatsoever. They're just going to take your order. And if it's good or bad or whatever, 100% on you. Absolutely no recommendations there. Online brokers. Deeper discount brokers trade electronically for a flat fee. You see these all the time. Again, there's going to be very little in terms of advice that's given here. They may give you resources by which you can do the research, but in the end of it, it's going to be all on you to make the choice based upon what your research tells you. And then there's just discount brokers, no advice, they'll execute trades, usually again for about half of what a full service discount or advisory service will do. So again, more cost effective, but again, you're taking on 100% of responsibility for the choice yourself. And that can be intimidating, but if you can do the research, go for it. It will save you money. Picking an advisor. I'm a financial advisor. There's a ability to check for FINRA. There's also a thing called broker check that you can look at. Lots of questions that you want to ask a financial advisor. First one, are you a fiduciary? I'll answer yes to that one. If they answer no, you're going to want to ask why and figure all that out as to whether or not they are in your best interest or not. If you don't know what a fiduciary is, well, it's someone who has to act with your financial best interests at heart, regardless of how much the fiduciary gets paid. This means finding the same type of products at cheaper prices, which means you get a better deal, the advisor gets paid less. That's the way I work. What experience do you have? Ask that question. If they've got a lot of experience, it's going to help you. If they have minimal experience, they're going to be learning and making mistakes with you as their client. Ask what the expectations are. How do they work? Do they contact you monthly? Do they contact you quarterly, annually? Only when they want to make a trade, right? How are you paid? Fee-only advisors work with their clients and compensated on a previously agreed upon fee. 1% is about the industry average. Some will charge more, some will charge less, depending upon the amount of assets and the services they provide. Do they charge commissions? If they're paying a fee, do they get commissions as well? How does all that work? What's the connection there? Legally bound to sell suitable products and services. Again, this goes back to the fiduciary. What's in your best interest? Is it in your best interest, or is it in their best interest because that's how they get paid? And then you want to ask about investment philosophy. If there's a philosophy that you don't necessarily agree with, you might not want to work with that person. But you've got to find out. The only way to find out is to actually ask the questions and get the answers. Fraud. You hear about it in the news. Fraud, fraud, fraud. There are examples of companies out there, well-known cases. You hear it all the time. Lawsuits. Fraud does exist. It happens. Protect yourself, though. If the investment sounds too good to be true, it probably is too good to be true. Fraudsters rely upon people that don't bother to investigate or ask questions. Asking questions is in your best interest. There's a thing called a perspective, which is written information. Ask for it, get it. If someone has insider information or they pressure you quickly, probably not a good sign either. Insider information actually is illegal to trade upon. So if they've had it, they're breaking the law. If you invest with them and they had trade on insider information, you're breaking the law as well. Don't go for the fraud. And check them out. Search for brokers and advisor in SEC and FINRA databases. Again, there's a thing called Broker Check. You can go in and check on the advisor to see if they actually are who they say they are and do what they say they do. Hopefully this has given you a good start on financial planning basics and investing 101. So you have an idea when you go and talk to someone about what to kind of look for. This should have given you a lot of things that you've learned. We're going to talk about that in a minute, but you should also have some questions. This didn't answer every question possible. This was an introductory 101 level course. So take it as such, go forth, ask some questions, get more education, and make some good investments. If you got any tips on how I can be better at this, I'd love to hear from you. So reach out, connect with me, ask questions, give me some feedback. Hopefully, in the course of this presentation, you've learned a couple of things. Investing versus savings. Investing is long-term, saving is short-term. Risk. What does risk mean for you? Hopefully, I've given you lots of terms and definitions so that you're able to be armed with a little bit of information. Hopefully, again, you've learned the difference between advisors, brokers, and agents, and are on the lookout for one that works best for you. And you've gotten a little bit about avoiding cautions and scams and know to check people out before you work with them. Again, my name is Chris Shea, I'm a financial advisor. I'd love to help you out. If you got any questions about any of this, feel free to reach out.